Let's start with revenue, as we need to know how big these businesses actually are. Broadcom's generated around $64 billion of revenue, while Marvell generated around $8.2 billion. So the first thing is very clear. Broadcom is not just bigger, it is in a completely different weight class. Over the last 5 years, both companies have actually grown revenue at a very similar pace. Broadcom grew revenue by about 22% per year on average, while Marvell grew by around 23% per year. So if we only look at 5-year growth, Marvell is not behind. But over 10 years, Broadcom grew revenue by around 25% per year on average, while Marvell grew by around 12% per year. That tells me Broadcom has been the more consistent long-term revenue compounder and has been running this marathon for longer. Now, looking forward, Broadcom is projected to reach around $106 billion of revenue in 2026, which would be a massive 66% increase. Marvell is projected to reach around $11.5 billion, which also very strong growth of around 41%. So this is important. Marvell is growing fast, but Broadcom is growing fast from a much larger base. That is much harder to do and is a different level of execution. This is one reason why Broadcom deserves a premium valuation. Revenue analysis shows this is like comparing a heavyweight boxer with a very talented lightweight. The lightweight may still be fast, but the punch size is different. Now let's move from growth to profitability. Broadcom's gross margin is around 76%, compared with Marvell's 52%. That means Broadcom keeps much more of every dollar of revenue after direct costs. Profit margin also favors Broadcom, 39% compared with Marvell's 29%. But with Marvell, we should be careful because part of recent net income was helped by a one-time gain. Marvell is profitable, so this is not a weak business. But Broadcom is clearly more efficient at turning revenue into actual profit and is operating like a premium quality business. Cash flow. This is one of the most important sections. Earnings are important, but free cash flow is where the business proves whether it is actually producing monkeys for shareholders. Just seeing if you are attentive. Over the last 12 months, Broadcom generated around $33.6 billion of operating cash flow and around $33 billion of free cash flow. That is extremely strong. Its free cash flow margin is around 43%, meaning a large part of its revenue is converted into cash. Over the last 12 months, Marvell generated around $2 billion of operating cash flow and $1.67 billion of free cash flow, with a free cash flow margin of around 19%. Again, not bad, but clearly not in Broadcom's league. A side note, if you find this type of stock comparison useful, consider subscribing the channel. I'll be doing more of these direct stock battles. Now, let's look at returns on capital. This section tells us whether the company is creating value from the money invested in the business. Broadcom's return on invested capital is around 24%, while its cost of capital is around 12%. That means Broadcom is earning well above its cost of capital, which is exactly what long-term investors want to see. Marvell's return on invested capital is around 7%, while its cost of capital is around 16%. That is a weaker picture. It does not mean Marvell is a bad company, but it does mean the market is valuing Marvell more on future potential than current capital efficiency. Broadcom is already creating strong economic value. Marvell needs future growth to justify today's valuation. On the balance sheet side, both companies look manageable. Marvell has a stronger current ratio and lower debt-to-equity ratio, so it looks more conservative from a debt perspective. Broadcom has more leverage, but it also has much stronger cash flow and interest coverage, so I am not too worried about Broadcom's debt because the company has the cash generation to support it. In simple terms, Marvell has the cleaner balance sheet, but Broadcom has the stronger cash engine. Now comes the most important part, valuation. Because a great company can still be a bad investment if you overpay for it. Before I share valuation comparison, I want to hear your views. Are you Team Broadcom or Team Marvell? Would you buy either stock at today's price? Broadcom has a market cap of around $1.78 trillion, while Marvell is around $223 billion. So despite of overvaluation concern, Marvell is still much smaller than Broadcom. On the flip side, it means it may have more room to grow. Broadcom trades at around 60 times current earnings, but only around 23 times adjusted forward earnings estimates. Marvell trades at around 88 times current earnings and 56 times adjusted forward earnings estimates. This tells us the market is expecting a lot from Marvell. The PEG ratio also favors Broadcom, 0.5 compared with Marvell's 1.5. Now, PEG is not perfect, but it suggests Broadcom's valuation may be more reasonable relative to its growth. Free cash flow yield is also important. Broadcom's free cash flow yield is around 1.91%, which is low, so Broadcom is not cheap. But Marvell's free cash flow yield is only around 0.78%, which means investors are paying much more for future expectations rather than current cash flow. Based on these figures, both stocks are expensive. The difference is that Broadcom is expensive with a cash flow receipt. Marvell is expensive with a promise note. Price to sales is also very interesting. Broadcom trades around 24 times sales, and Marvell around 25 times sales. On the surface, they look similar, but the quality of those sales is different. Broadcom has higher gross margins, higher profit margins, and much stronger free cash flow. So paying a similar sales multiple for Broadcom may be easier to justify. Now let's look at shareholder returns. Broadcom has delivered around 54% annualized returns over 5 years and 41% over 10 years. Marvell has also performed very well with around 35% over 5 years and 40% over 10 years. So both stocks have rewarded shareholders. Risk is where the difference becomes clearer. Broadcom's 5-year beta is around 1.5, while Marvell's is around 2.3. That means Marvell has been much more volatile. Marvell can move fast. The problem is it does not always ask investors which direction they prefer. Short interest is also higher in Marvell at around 4.5%, compared with Broadcom at around 1.3%. That does not guarantee Marvell will fall, but it shows more investors are betting against it or hedging against downside. If you think I missed an important metric, comment it below. I may include it in the next stock comparison. Now let's talk about what these companies actually do, because both are called AI plays, but their business mix is different. Broadcom has semiconductors, custom AI chips, networking, connectivity, and infrastructure software through VMware. So Broadcom is not only an AI chip company, it is also a major infrastructure software company. Marvell is more focused on custom silicon, data center networking, optical interconnect, storage, Ethernet, and AI data center connectivity. In simple words, Marvell helps move data inside AI infrastructure. Broadcom is more diversified. Around 58% of annual revenue came from semiconductors and 42% from infrastructure software. But in the latest quarter, semiconductors increased to around 68% of revenue, mainly because AI chip demand is accelerating. Marvell is much more concentrated in data centers. Around 74% of its annual revenue and 76% of its latest quarterly revenue came from data center customers. This gives Marvell very direct AI exposure, but also makes it more dependent on one major theme. What could go wrong? One risk that investors should not ignore is customer concentration. In AI semiconductors, a few hyperscale customers can drive a very large part of revenue. That is great when orders are growing, but it can hurt badly if one large customer delays spending, changes supplier, or develops more technology internally. Broadcom disclosed that its top 5 end customers represented around 40% of revenue. So even though Broadcom is large and diversified, it is still meaningfully dependent on a small group of major customers. But Marvell's concentration looks even higher. Its top 10 customers represented around 82% of revenue, and in the latest quarter, 3 customers represented 75% of gross accounts receivable. So Marvell has strong exposure to large AI and data center customers, but that also increases dependency risk. When a few big customers love you, revenue can grow very fast. But if even one big customer says, let's take a break, the stock market may not take it calmly. Before moving forward, just a friendly reminder. This video is not a financial advice. Now let's look at analyst price targets, as they are useful as a sentiment check. They tell us whether Wall Street sees meaningful upside from the current price or whether the stock may already be close to what analysts think is fair value. For Broadcom, stock analysis shows a strong buy rating with an average 12-month price target of around $524 and a high target of $650. This shows an upside of 44% to 78%. Market beat is slightly more conservative, showing a moderate buy rating and an average target of around $493 with an upside of 36%. Tip ranks also shows a strong buy rating with an average target of around $517 with an upside of 42%. So across these 3 sources, Broadcom's average target is mostly in the $493 to $524 range. That suggests analysts still see meaningful upside in Broadcom, even after the stock's strong performance. For Marvell, analysts are also positive. Stock analysis and tip ranks show a strong buy rating, while market beat shows a moderate buy rating. So this is not a case where analysts dislike the company, but the important difference is the upside. Marvell's average targets are mostly around $245 to $270, depending on the source, with an upside of 9 to 20%. That is not bad, but it is much closer to the current stock price than Broadcom's targets are. This means analysts are basically saying Marvell is a high-quality AI infrastructure company, but a lot of good news may already be reflected in the stock price. So here's my final view. Both Broadcom and Marvell are strong companies. Both are growing revenue, both are benefiting from AI infrastructure, and both have rewarded shareholders very well. But if I compare them side by side, Broadcom looks like the stronger business today. It has larger revenue, better margins, stronger free cash flow, better returns on capital, and a more reasonable valuation compared with Marvell. Marvell is not a bad company. In fact, it may have higher upside if AI data center demand continues to accelerate, but the stock already prices in a lot of optimism. So for me, Marvell belongs on the watch list, and I would be more careful about valuation before taking a position. Broadcom also does not look cheap in absolute terms. This is very important. I am not saying Broadcom is deeply undervalued. It is just that compared with Marvell, Broadcom looks more attractive on a risk-reward basis. So if I had to choose one for a balanced long-term investor, I would lean toward Broadcom. For a more aggressive investor who can handle volatility and believes strongly in Marvell's AI growth story, Marvell may still be interesting, but at today's valuation, the margin of safety looks thinner. If this helped you understand Broadcom and Marvell better, please hit the like button, subscribe for more stock comparisons, and I'll catch you in the next one. Do let me know in the comments which comparison you want next. Thanks for watching.